Welcome to the deep dive. We're here to cut through the jargon and get straight to the knowledge you can actually use.
That's the plan.
Today, we're tackling a really important piece of financial reporting, diluted earnings per share.
Specifically using the Treasury Method for part of that calculation.
Exactly. Our mission, as always, is to take this sometimes complex accounting stuff and, well, make it clear, concise, and genuinely useful for you.
Turning complexity into clarity.
Before we really dive in, though, just a quick reminder, this deep dive draws heavily on material from Farhat lectures.
Right.
All the content, the examples, the explanations we'll be talking about today, they're derived from the accounting resources over at farhatlectures.com.
It's a great resource.
Definitely. So whether you're an accounting student studying for the CPA exam or already a professional, you should check out the website for more practice, video lectures, and just great support on today's topic.
And a big thanks to Professor Farhat for making this material available.
Absolutely. Okay, let's get started. When we talk about profit per share, the first thing most people think of is basic earnings per share, basic EPS.
Right. That's the starting point.
But what actually goes into that? Why do we begin there?
Well, basic EPS is just that it's the fundamental measure. How much profit did the company make for each common share that's, currently out there? It's a snapshot.
Okay.
And the formula, it's pretty straightforward. You take net income, then you subtract any preferred dividends.
Ah, okay. And there's a specific rule about those preferred dividends, isn't there?
Yes, exactly. Little nuance there. You always take them out if they're cumulative preferred dividends. Always.
Even if not paid.
Even if not paid, if they're cumulative. But if they're non-cumulative, you only subtract them if they were actually declared during the period.
Got it. So net income minus those preferred dividends.
And then you divide that whole thing by the weighted average number of common shares outstanding during that period.
Weighted average. Okay. So that accounts for shares issued or bought back during the year?
Precisely. It smooths out the changes.
So that's basic EPS. Sounds simple enough. But then, when does this idea of diluted EPS even come into the picture? When do we need that?
That's where things get a bit more complex. It really comes down to whether a company has what's called a complex capital structure.
Complex capital structure. What makes it complex?
It means the company has certain types of securities out there that aren't just plain common stock, but they could potentially become common stock later on. We call these dilutive securities.
Okay, like what kind of things?
We're talking about things like convertible bonds or maybe convertible preferred stock. Also, employee stock options, warrants. Basically anything that gives the holder the right to get common shares in the future.
I see. So things that could increase the number of shares.
Exactly. And think about the basic EPS formula shares, outstandings at the denominator, right?
Right. Bottom number.
So if that number potentially goes up because these securities get converted or exercised, well, your earnings per share could go down.
Ah, dilution. Makes sense. Less earnings spread across more shares.
That's the potential dilution effect we're trying to capture.
Yeah.
It's a what-if scenario. What if these potential shares became real shares? Diluted EPS gives you that more conservative look.
So you calculate it just in case.
Well, yes, but you only report diluted EPS if the calculation actually shows a lower number than basic EPS.
Oh, really?
Yeah. If doing the math somehow makes EPS go up or stay the same, we call that anti-dilutive, and you just stick with reporting basic EPS. The focus is purely on the potential downward pressure.
Interesting. So we're trying to find the worst case reasonable scenario for earnings per share.
You could put it that way. It's about transparency for investors regarding that potential dilution.
Okay, so for some of those dilutive securities, specifically options and warrants, you mentioned there's a particular method called the Treasury Method. How does that work?
Right. The Treasury Method is a specific technique we use for options, warrants, and similar instruments, where exercising them usually involves the holder paying some cash to the company. And it works based on two key assumptions. They're hypothetical, but crucial.
All right, what are they?
Assumption one is about timing. The method assumes that the holders exercise their options or warrants right at the beginning of the year.
January 1st, basically.
Yeah. Or if the options were issued during the year, say on July 1st, then you assume they exercise them on that issue date, July 1st, for the rest of the year.
Okay, so assume exercise happens as soon as possible. What's assumption two?
Assumption two deals with the cash. Remember, exercising an option usually means paying the company an exercise price, right?
Yeah, you pay money to get the shares.
So the company receives these cash proceeds. The Treasury Method assumes the company immediately uses that cash to buy back its own shares from the open market. buying Treasury stock.
Ah, okay. So it's like a circular flow. Shares go out from the option exercise, but cash comes in, and then shares come back in from the buyback.
Exactly. And here's a critical point. The buyback is assumed to happen at the average market price of the stock during that period.
Not the price on Jan 1st or the exercise price.
No, the average market price throughout the year, or the relevant part of the year. This aims to reflect a more realistic market condition for the buyback.
That makes sense. So it's not just assuming new shares flood the market. It nets out the effect of the cash received. It feels more balanced.
It is. It's designed to show the net increase in shares that would result from the exercise and the theoretical use of the proceeds. It gives a more realistic, though still hypothetical, picture of the maximum potential dilution from these specific instruments.
This sounds like something an example will really help clarify.
Definitely. Abstract ideas always land better with concrete numbers.
Okay, let's use an example from the source material. Let's say we have a company, Farhat Lectures.
Okay.
For the year 20x5, their net income was $400,000.
Got it. 400K.
They had 40,000 shares of common stock outstanding all year. Pretty straightforward.
40,000 shares. Basic denominator.
And they also had 2,000 stock options outstanding. These were issued back in 20x4, so they were there for the entire year 20x5 from January 1st.
Okay, 2,000 options, full year.
Each option lets the holder buy one share of common stock at an exercise price of $10.
Exercise price $10. Important number.
And one more key piece. The average market price of Farhat Lecture stock during 20x5 was $25 per share.
Average market price $25. Okay, we have all the pieces.
So first things first, what's the basic EPS?
Easy enough. We take the net income, $400,000, no mention of preferred dividends, so we assume zero.
Okay.
Divide that by the weighted average shares, which was constant at 40,000 shares.
So 400,000 divided by 40,000.
Comes out to exactly $10 per share. That's our basic EPS, our baseline.
$10 basic. Okay, now bring in those 2,000 options. How does the Treasury method apply here? What's step one?
Step one, apply the assumptions. We assume those 2,000 options are exercised. Since the exercise price is $10.
The company gets cash, right?
Right. 2,000 options times $10 per option means the company hypothetically receives $20,000 in proceeds.
Okay, $20,000 cash influx.
Now, assumption two.
Yeah.
The company uses that $20,000 immediately to buy back its own shares. At what price?
The average market price, which was $25.
Exactly. So how many shares can they buy back with $20,000 if the price is $25?
Let's see, 20,000 divided by 25, that's 800 shares.
Correct. They hypothetically buy back 800 shares.
Okay, so let me recap the flow in my head. The options get exercised, so 2,000 new shares are issued to the option holders.
Yep.
But the company uses the cash from that exercise to buy back 800 shares from the market.
That's the Treasury Method logic.
So what's the actual net change in the number of shares outstanding that we need to consider for diluted EPS?
That's the difference. You have 2,000 shares issued minus the 800 shares repurchased.
So 1,200 shares.
That's it. We call that the incremental increase in shares due to the options using the Treasury Method. 1,200 shares.
Okay, an incremental 1,200 shares. Now, how do we get to diluted EPS?
For diluted EPS, the numerator net income stays the same. Still $400,000 in this case because exercising options doesn't directly change net income itself.
Right.
But the denominator changes. We start with the basic weighted average shares, which was 40,000.
And add the incremental shares.
And add those 1,200 incremental shares we just calculated. So the new denominator is 40,000 plus 1,200, which is 41,200 shares.
Okay, so diluted EPS is $400,000 divided by 41,200 shares. What does that come out to?
Punching that in, $400,000 divided by 41,200 gives us $9.70 per share, rounded.
$9.70. Okay, and comparing that to the basic EPS.
Basic was $10. Diluted is $9.70.
So it is dilutive. The potential shares lowered the EPS.
Correct. Since $9.70 is less than $10, the options are dilutive, and we would report both basic EPS of $10 and diluted EPS of $9.70.
And it's worth pointing out, those options were in the money. Right. The $10 exercise price was way below the $25 average market price.
Absolutely. That's a key condition. In the money means it's financially advantageous for the holder to exercise the option.
Because they can buy a $25 stock for only $10.
Exactly. If the options were out of the money, say the exercise price was $30 when the market price was $25, then they wouldn't be dilutive.
Why not?
Because nobody would rationally exercise an option to buy a share for $30 when they could just buy it on the open market for $25. So Out-of-the-money options are considered anti-dilutive and are ignored for the calculation.
Got it. So the in-the-money status is sort of a prerequisite check before you even run the Treasury Method numbers.
Generally, yes. It signals potential dilution.
This really shows how diluted EPS gives that more cautious perspective. The $10 basic looks good, but the $9.70 tells you what could happen.
Precisely. A fuller picture for anyone analyzing the company.
Okay, let's treat the scenario. What if those same 2,000 options weren't outstanding for the whole year? What if they were issued, say, on September 1st, 20x5? Everything else stays the same: net income, basic shares, prices.
Okay. This brings in that timing aspect we mentioned, proration.
Proration, how does that work?
Well, the first part of the Treasury Method calculation, figuring out the potential incremental shares if exercise stays the same.
So we still calculate the proceeds, $20 K, the shares bought back, 800, and the initial incremental amount, 1,200 shares.
Yes, that hypothetical 1,200 share increase is still the starting point. But because these options only existed for part of the year, their dilutive effect only applies to that part of the year.
How long were they outstanding in this case? September 1st to December 31st? September, October, November, December? That's 4 months.
Exactly. 4 months out of a 12-month year. So we need to weight that 1,200 incremental share figure by the fraction of the year they were outstanding.
So 1,200 times 4 divided by 12.
Correct. 1,200 times 412, which is 1/3. That gives us a prorated incremental increase of 400 shares.
Only 400 shares added to the denominator now instead of 1,200 because they weren't around for the full year.
That's the logic. You only count the potential dilution for the period the potential existed.
Okay, so how does this prorated number affect the final diluted EPS calculation?
Again, the numerator is still $400,000. The denominator is our basic shares, 40,000, plus this prorated incremental amount.
So 40,000 plus 400 equals 40,400 shares.
Right. The diluted share count is 40,400. Now we calculate diluted EPS, $400,000 divided by 40,400 shares.
Okay, 400,000 divided by 40,400, that's $9.90 per share, rounded.
$9.90.
Interesting. So still dilutive compared to the $10 basic EPS, but less dilutive than the $9.70 we got when the options were outstanding all year.
Makes sense, doesn't it? The potential dilution had less time to impact the average for the year.
It really highlights how sensitive these calculations can be to timing. A seemingly small detail like the issue date makes a tangible difference in the reported diluted EPS.
Absolutely. It underscores the need for careful application of these accounting rules to get an accurate picture.
So just to recap our journey here, we started with basic EPS, the simple snapshot.
Net income minus preferred dividends, overweighted average shares.
Then we saw why we need diluted EPS for companies with complex capital structures, things like options that could lower EPS.
Capturing that potential dilution effect, showing a more conservative number.
And for options and warrants, we dug into the Treasury Method.
Assuming exercise, and assuming the proceeds are used to buy back shares at the average market price.
Which leads to calculating those incremental shares, possibly prorated based on timing.
Which we then add to the denominator to calculate the final diluted EPS.
The examples really brought that to life, showing the difference between full year and part year options.
Yeah, seeing the numbers change based on the facts makes the concept stick.
So connecting all these dots for someone listening, why does mastering this nuance matter beyond just passing an accounting exam?
Well, understanding this stuff is really crucial if you want to truly evaluate a company's financial health. Basic EPS might look good, but if there's significant potential dilution lurking.
The diluted EPS tells a more complete story about shareholder value.
Exactly. It shows you how future events, like options being exercised, could impact the earnings attributable to each share. It raises a key question for anyone analyzing a company. How does knowing about this potential dilution change how you personally look at their reported earnings?
It makes you look beyond the headline basic EPS number for sure. You want to see that diluted figure to understand the full potential impact.
It's a critical piece of due diligence for investors, analysts, anyone making decisions based on these numbers.
And if you want to really get comfortable with these calculations, practice is key, right?
Absolutely. That's why the source material, Farhat Lectures, really emphasizes working through more problems. On farhatlectures.com, there are tons of multiple choice questions, more examples, video explanations.
It really helps solidify the concepts.
Definitely. Professor Farhat stresses that investing the time to understand topics like diluted EPS, especially if you're aiming for something like the CPA, is a real investment in your career. You don't want to cut corners on learning this material.
Sound advice. It's about building that deep understanding.
Couldn't agree more.
Well, that feels like a comprehensive deep dive into diluted EPS and the Treasury method.
Throwing a lot of ground.
That's all the time we have for this deep dive. Keep asking questions, keep digging deeper, and join us next time.